Good afternoon. My name is Debbie Bannister. I'm with Exchange Resources. We're a qualified intermediary, and that's the type of company that would facilitate a 1031. I'm also joined here with my partner. His name is Frank Bideau, and Frank will also help us in the slide presentation, or in this presentation with us this afternoon. We're going to go ahead and talk a little bit. Our whole discussion is going to be about 1031 exchanges and the value of them, and really as a real estate professional, what your responsibility is in regards to assisting a client. So we will narrow down all the little details so that you can really understand what you need to, the things that you'll need to do in regards to assisting your client. So we'll go ahead and get started. The first slide the first slide of the presentation asks the question, why pay taxes now? And this is in regards to the 1031 exchange. And a 1031 exchange is a transaction basically that allows an investor to defer the payment of capital gains tax by doing this 1031 exchange. So they would be selling investment property, and thus they would need to buy more investment property. It brings out a question that says, what does like kind mean? So in the 1031 code, you hear the language like kind. And a lot of people have misinterpreted perhaps what that means by thinking that if you're selling a single family investment, you have to buy another single family investment. Selling commercial, you'll have to buy commercial. But the reality is that the like kind requirement has nothing to do with the type of property that's being sold or the type of property that was held for investment purposes, but everything to do with how it was used. As you notice on the slide, it says qualified use of the property. So it has everything to do with how this property was used. So for a property to qualify for a 1031 exchange, it must be investment property. Per the tax code, it's investment property or property used for the productive use of a trade or a business. Now that goes into perhaps a few questions before we start talking about this slide. It leaves a few questions regarding other types of properties. So from the tax code perspective, there's really three types of properties that IRS classifies. So we have one, the primary residence. Second one, second home. Third, investment property. And it's important to know these classifications because a primary residence, if it's just used as a primary, wouldn't qualify for a 1031. It has its own tax shelter called the 121, which you're probably most familiar with. And that is the universal exclusion if someone has owned the property for 2 years consecutively or 2 out of the last 5 years of use of ownership. And if they've lived there, then it qualifies for the universal exclusion. So if the person owning it is married, they can have up to $500,000 of tax-free money from an exclusion. So that first $500,000 is tax-free. If they're single, the first $250,000 is tax-free. But of course, if there's any gain after those exclusionary amounts, then unfortunately they have to pay taxes. So that's the primary. Then we have the second home, which causes a lot of confusion. And I want to talk about that real quick before we go into some of these qualified properties that we see on the screen. IRS has classified, drawn a line in the sand, if you will, and helped us understand what a second home is versus vacation rental. Because some people may not, may have a property like in Big Bear, wherever, and maybe they rent it out seasonally. So does that qualify as investment property? So the qualification is this, per the tax code. As long as the property minimally is rented 14 days a year, minimally, but not used personally more than 14 days a year, then it would qualify actually as investment property. And actually, they can use it, there's an and or, so they could use it 14 days a year minimally, or they can use it 10% of the time rented, and they get whatever's greater. So what that actually means is, say you rent it out for 200 days a year. Now you can use that property for 10% of the time rented. You can use it for 20 days, and it's still investment property. But if, let's say you have a house at the ocean and a house at the beach, you rent out the house at the beach 6 months a year, and then you live excuse me, I got confused. A house at the desert and a house at the beach. So the house at the beach you live in for 6 months, and then you go to the desert. You live there for 6 months, and then you rent out each of them for the other 6 months. That scenario actually keeps that classification of that property would be a second home and not investment property, because now you have used it more than that threshold that we just discussed, 14 days or 10% of the time rented. So it's important to understand that, because if someone's selling something that there's a lot of personal use, they may say, well, I do rent it out. It's personal use that will either qualify or disqualify it. So that's the second home. And then then investment property is the last category. Remember, we have primary, second home, and investment property. Investment property is what we've already discussed, is property that's either rented out or used for a trade or a business. So now let's look at the slide 3 that we see here. It asks what qualifies as replacement property. Because remember, I told you it wasn't the type of property, but how it's used. So someone could sell a single family home and buy multifamily, or they may sell commercial and maybe buy raw land. That does qualify. Or they could sell maybe the multifamily and they want to buy some oil and gas royalties. That would qualify. So, or air rights. So as you can see here, there's a lot of things that they can do. People can change the type of property they have in a 1031 exchange. This allows them to perhaps increase their portfolio or enhance their portfolio with properties that may perform better than what they've had. I've had clients that have done exchanges. They've had lots of raw land. I had a client that sold like $60 million worth of raw land in Sacramento a few years back. And that exchange, he sold something that honestly didn't have an income on it, but that sale allowed him to exchange into single family and multifamily residence. And he was able to change his whole real estate portfolio to something that didn't have an income, to something that created an amazing income for him. So that's just one example of what people do and how they utilize the 1031 exchange. Okay. And if there's any questions as we go through, you can post it in the chat and even the Q&A, whatever is easier for you. We will help you out and answer your questions. Okay. So we've been talking about what qualifies. So now let's talk about what doesn't qualify. So when it comes to a 1031 exchange, we already talked, I'm going to go from the bottom and work my way up on this slide. We've already talked about the primary residence. The primary residence wouldn't qualify for the 1031 exchange. And like it says here, the 121, which is the number in the tax code for this universal exclusion, allows up to 250 or 500, either being single or married, of protection from a taxation on the first 250 or 500 gain that you may have. So that would be totally tax-free. Then stocks and bonds, those are not considered real estate. People buy into REITs, and even though it's a real estate portfolio, in reality, it's a stock transaction. and due to the fact that it is a stock transaction and evidence of ownership is via a stock certificate and not a deed, that does not qualify for replacement property or to sell and do a 1031 exchange. And then the last thing is in 2018, we had a change to the tax code regarding the 1031 exchange. And before 2018, we were able to do personal property exchanges with art collections or machinery or collectibles, things like that. And the code changed at that time, and personal property has been eliminated and taken out of the code. So there are no more personal property exchanges at all. It used to be if you say you had a dental practice and you sold the practice and the real estate, you could do an exchange on the practice and buy another dental practice, and then you would do an exchange on the real estate. So in this scenario, there's no more exchanging the dental practice. All personal property has been eliminated from the 1031 code. Okay, so we did talk about this, but we're going to go into this because there's a few people that came on a little later. Just again, I wanted to emphasize vacation homes. This is very confusing for a lot of people. So they may have a vacation home. They use it personally. Oops. They use it personally. They rent it out. So a lot of things are going on at the same time on this property. But it would only qualify as investment property if the property was owned and held for at least 24 months. So that's very important. The property is rented out at least, in reality, it's at least 14 days for those 2 previous years. So if you had, for example, a vacation home in Lake Arrowhead, and the family's been using it, and it's been a great place. But now kids are off in college, life has changed, and you've been renting it out seasonally. So the 2 previous tax returns before selling it, if it's been reported as investment property and follow this criteria, at least rent it out at least, this says 15 days a year, not using it personally more than 15 days a year, or 10% of the time rented. So not using it more than 14 days a year, or 10% of the time rented. If you draw a line in the sand and follow those instructions, then it does qualify for investment property. But it's important to set it up. It needs to have a history before you can claim it. It needs to have a history of being investment property before you can just jump into the 1031. So this is really important criteria, that 2 tax returns before selling that property and utilizing the 1031 exchange, it's reported as investment property, and then follow these amount of times of minimal rentals and use of time for personally using that property, then it will qualify without any problems in regards to 1031. Okay, there's a few questions maybe, it looks like. Oh, no. Okay, perfect. Now I'm going to introduce Frank Bideau, and Frank is going to talk about the next 2 slides. So slide 6. Okay, Frank.
Everyone. David, would you mind to maybe skip to the next slide? I think. Perfect, thank you. So let's start with this. So why would you or someone do a 1031 exchange, right? And actually that is a great way to start a conversation with possible customers and to introduce them to what really a 1031 exchange is, but also as a way to possibly generate more business for you or more listings. So let's go through those little different pieces here. So the number one reason why doing a 1031 exchange is to defer your capital gain taxes. And then we'll go over that in the following slide. You'll see that by deferring your taxes, rather than reinvesting only a portion of your proceeds, you'll be able to reinvest 100% of your proceeds, thus being able to acquire more real estate. So this is one of the first reason why people choose to do a 1031 exchange. Number two, like Debbie touched on that, is portfolio reallocation. How is your portfolio performing? So, like Debbie mentioned, this gentleman who owned a large piece of land. Obviously, no income was generated from that, so it made sense for him to move that investment into something that could generate rent, and those being a little more profitable for him than just the raw land. So a great way to reallocate investments across multiple type of investments. And then so that diversification, consolidation is a big thing as well that we just talk about. The other thing too is from a tax standpoint, looking at depreciation. Depreciation basically is something that you would take on an asset. So again, you cannot depreciate land, but you can depreciate the structure of building, right? So for residential, you'll be able to depreciate that structure for over a period of 27.5 years. So basically, let's assume that your structure is worth 100,000. So you divide that up by 27.5 years, and that whatever amount is each year, you would be able to write that off on your tax return against your investment income. So once you are reaching that 27.5 years, obviously that tax benefit disappears, and then you're losing, in a sense, that tax benefit. So a side note on that is, as maybe you're prospecting for a new business, you may want to ask your title company to look for people who have owned investment properties for more than 27 years, 7.5 years, maybe 20 years, because that will give you the indication that those people are really nearing the end of that precious tax benefit. And it would be a great way for you to basically introduce yourself to those people and talk about 1031 exchange and the benefits of exchanging to gain again by exchanging into a new property, being able to benefit about that depreciation as well. And then finally, having a nested plan. So you can basically exchange forever, and I don't know if I mentioned that before, but a 1031 exchange doesn't erase the taxes; it just defer them, right? So it's not like those capital gain taxes are going to be disappearing. They are just being deferred as long as you keep exchanging, right? So and then you can basically, like we say, you can defer until you drop, meaning that until you pass, that person pass away, and then the heirs would basically inherit that property with a full step up in basis. So basically at the fair market value at the time of death. At that point, the heir would, if they wish to keep that property, great, but if they wanted to sell that property and split the money among themselves and moving, forward, then they could do that by just selling the property at fair market value and avoiding paying capital gain taxes on that. I hope that makes sense. Again, if you have any questions on that, please you can put that in the chat box, and then we'll be happy to answer those. Debbie, let's go back to slide 6, if you don't mind, and then let's talk about doing a 1031 exchange versus not doing an exchange. So by doing a 1031 exchange, everything that you're seeing on that screen right here, you'll be able to postpone, right? So what if you're selling a property for $1 million, and then if you had to pay if you were just to cash out and basically sell that property without exchanging, then you'll be faced with the taxes that you are seeing on the screen. So to begin with, we'll start with Fed taxes, federal taxes on capital gain, which would be between 15 and 20% based on your tax bracket. Then you would add your state tax. So if we take California, that would be up to 13.3%. And then you would add what we call, we touched on that on the previous slide, the depreciation recapture. So 25% of the total amount, the aggregated amount that you have depreciated over the years. So if you have depreciated your property over the full 27.5 years, and that total amount of depreciation add up to 100,000, then you'll be paying 25% of that, so $25,000 in taxes in addition to your Fed and state taxes. And then again, based on your tax bracket, I believe if you're making, Debbie, correct me if I'm not right on that, but if you're making about above $250,000 in ordinary income every year, then you would be taxed at 3.8% affordable health care surcharge, or what we call the Obamacare tax. So this is basically what you will be looking at. So if we were to sum all that up, you're looking at about 35, maybe to 40% based on your particular situation that you'll be paying in taxes on the property that you are selling. So if you're selling a property for $1 million, then you have to pay 35% in taxes, then that will leave you with only $650 to reinvest. Again, here the benefit of doing an exchange is rather than using that $650, then you'll be able to use the 100% of the 1 million and reinvest 1 million, and then to gain that way. So this is one of the primary benefits amongst the other one that we discussed before to choose to do a 1031 exchange. Debbie?
Okay, I'm just looking at a question that we have here online. I'm going to address that question, if it's okay with everybody. The question was, would the heirs have to pay the full capital gains tax if they sell? And I responded by on here that if it's owned in a family trust, and if the value of that property, first of all, will need to be determined at the time of death. So say that they inherited, the parents or whoever owned the property that is deceased, say it was valued at $1 million. They bought it, let's say, for $500,000, but now it's valued at $2 million. So if they sell it for $2 million, there would be no taxable event due to that stepped up in basis. But if they sell it for 2.5, then they pay taxes on anything after the 2 million. So that's the answer to that question. Is there any other questions regarding to what I just said in regards to that question? The other question I wanted to bring up too was, Wendy brought it up, can you convert a primary residence to investment property, like rent it out, say for 2 years? So let's talk about that for a moment before we go back to our remaining slides. There's a provision in the tax code that if someone is selling a primary residence, let's say they have $1 million gain. So the way the tax code is currently, if they're married, they get the first $500,000 tax-free. So in this example, the last $500,000 they're going to pay capital gains tax on. But if they choose to rent out, say they've lived in that house for 39 years or 40 years. So in the last 5 years, say this is when they sell it. So the last 5 years going backwards, they lived in the house for 39 and 40. So those they lived in the house 2 years of the last 5 years. And if they rent it out for the next 2 years and then sell it before the 5th year is up, now they qualify. And only in this situation, they qualify for both the 121 primary residence exclusion and the 1031, because the last use of this property was rented out and they sold it before the 5th year is up. So what that means is in the last 5 years, they have primary first, rental second, they sell it. So now what happens is they had $1 million gain. So they get the first 500,000 tax-free. So the last 500,000, all they have to do is buy something equal or greater to that 500,000. And then they deferred all their capital gains. So they got the first 500,000 tax-free. They were able to buy equal or greater and do an exchange with the last 500,000. And now they were able to utilize, they were able to get the most benefit out of these tax shelters. So I hope that answers the question from Wendy. So yes, you can convert it, run it out for 2 years. And if you sell it before the 3rd year's up, you can take advantage of both tax shelters. Okay, any further questions, please feel free to post them. Okay, so let's go back to our slide presentation. Now, what's really important when it comes to a 1031 exchange is how the client is holding title. So when you're on that listing appointment and you've done your homework before you go to the listing appointment, you pulled up a property profile, you know exactly how the owner is referenced on title. So if it's owned by an individual, like for example, it says John Smith, then John Smith needs to be the buyer. If it's owned by a single member LLC, then this is unique because a single member LLC is what IRS refers to as a pass-through entity. And what that means is that this LLC is filed through the taxpayer's 1040s, and it reflects, that LLC reflects back to them as a person. So what that means is in the LLC and out of the LLC, the taxpayer is still John Smith. So John Smith, if he wants to buy replacement property, but his lender won't let him get a loan in the name of his single member LLC, if he has to switch out and get a loan in his name, the taxpayer doesn't change. It's the same. But the next one is entirely different. We have a multi-member LLC. A multi-member LLC, this is entirely different because the members of the LLC are not the owners of the property. That LLC is the taxpayer that owns the property, and that LLC will be the taxpayer that will be selling, and that LLC will be the taxpayer that needs to buy. So a lot of times, some of these clients potential clients and clients that we work with, they may have owned the property, they may own this property in an LLC. So when you're on the listing appointment, it's really important to establish who are the members of the LLC. Is it just a single person? Then it's that single member LLC and we're okay. If not, so let's say it's just a husband and wife, then it's important we can find out, but it's important to find out if the LLC, since it's just a husband and wife, did they file for a disregarded entity? If it's a disregarded entity, then it's filed through their tax returns. It's connected to their social security number. So them as a taxpayer, again, in that LLC and out of the LLC is the same. The taxpayer doesn't change. That's a disregarded entity. So this could happen with a married couple. They could file this when they had the corporation created. It could be this disregarded entity. We try to find out so that we can help that taxpayer. If something came up with a loan down the line and they had to leave the LLC and get the loan in their name personally, then it wouldn't disrupt their exchange. So we're going to put that over to the side. So what's important to know is anything else, an LLC, multi-member LLC, all those members are not the owner of the property. It's the LLC, and we have many clients that have called us and they want to take their share of this property because there's maybe 4 members of the LLC. So they think they have 25% share of this property, which they do inside the LLC. but they want to take their 25% and do their own exchange. And everybody else, the other parties, the other three parties want to do the same. But that doesn't, it wouldn't work because the members are not the owners of that property. So this is real important to get to the bottom of this before they sell, to find out, make sure that everybody's on board, make sure they all understand if there's a multi-member LLC, that these members are not individually going to be exchangers and individually exchanging their percentage. They would need to, you know, the corporation will, the LLC, the corporation will be the exchanger. Now, for people that want it broken out, this is not a quick fix. So if the property is being listed and they want to break it out, it's too late. Properly, the right way to do it would be like 2 tax returns earlier. The owner, the LLC that owns that property, all the members would need to have a final K-1 filed, dissolve that LLC, and then deed it to each party, that real estate, that piece of real estate, deeded to each member of that LLC for their percentage. So for example, if there's 4 members, then all those 4 members would be, they'd get deeded out of the LLC. And then those 4 members would all have their 25% as tenants in common. But that, if they're coming to you at time of listing, it's too late because it needs to season at least 2 tax returns before that breakout. So then the next alternative would be that the LLC would buy, they would have to do some sort of agreement and let the LLC perhaps buy 4 properties that if the LLC was dissolved, member A would get this property, member B would get that property, so on. And then let it season for 2 tax returns as the LLC being the owner. Then under the direction, they would need to check with their CPA, and under their direction, then they would drop it out, deed it out after 2 years, dissolve, all members would get a final K-1, and then deed it to them individually. So it is not a quick process. It takes time to season. So if anybody needs help, if you have clients that have this situation where they want out, please help. Frank and I are very happy to help talk to the client and explain what they can and can't do in regards to trying to get out of that LLC. But it just let you guys know it's not a quick process. So that's everything in regards to the single member LLC, a disregarded LLC with a husband and wife, and then a multi-member LLC. So those are the things that we need to know. Now, the tenants in common, the TIC, the last choice here, that's what most people want, so that if there's multi-people owning the same property, so say, for example, 4 people, and on the deed, each person has 25% ownership of the property. When they sell that property, since everybody's referenced on the deed, then they can take, each party can take their percentage, and they can all do what they want to do. So for example, one person may want to take their percentage, their 25% of the sale, and buy and not do an exchange and pay the taxes and just cash out. Another party, the other 3 may want to do exchanges with their 25%. So that absolutely, they would all have their own exchange, and they can do what they want with their 25%. So tenants in common is wonderful, especially for people that want to go their different directions. So just remember that the same taxpayer who holds the title to the sale or relinquished property must be the same taxpayer that holds title to the replacement property. And it's all about that tax identity. So if there's multi-members in an LLC, that LLC is the taxpayer that owns it, the sale property, and that LLC will be the taxpayer that needs to buy. And if anybody needs help to explain to clients why they can't break out, then we'd be more than happy, Frank and I, to help so that the clients understand. Okay, so I'm going to go ahead and move on to the next slide. So when it comes to 1031 exchange, there's certain fees that we can deduct off the top in regards to being allowable fees in an exchange. So allowable fees in an exchange are the non-recurring closing costs. So we have the things that are non-recurring would be the title insurance on the sale. We have notary fees, recording fees, the big ticket item, the commissions. We have, if there's tax advisors that were utilized in this process, then that fee would be considered non-recurring. We have tax or transfer tax fees for the city, county. Those transfer taxes are definitely non-recurring. We would have sometimes in other states, we have attorney fees, we have inspection fees, the 1031 fees, escrow, and then this is the interesting one, contractual conditions of the sale. So what that means is if there was for example, if there was an inspection done and there's work that is needed as a result of the inspection, say termite work and then rebuilding a patio outside, then then it just needs to be made part of the condition of the sale, and whatever money is used to rebuild the patio and bring this property up to par per the inspection, then those fees would be allowed as far as those fees would be considered non-recurring and they would be allowed. Now, there's a difference between that, having a repair or an improvement because of per the contract, maybe as a result of an inspection. So there's a difference between that and wanting to deduct the fees because you spent money on preparing the property for sale. So some of the clients will call me and they'll say that they just put $20,000 in the property and get it ready for sale. And those, as far as IRS is concerned, are not included in this list and non-reoccurring. The viewpoint that IRS has is that that money was used to get the property ready for sale. They got a better price for it because of that. Those improvements would be taken care of by the CPA and be added to their cost base, be adjusted into their cost basis, but it's not something that would be deducted from the sale. But the question is, what are they deducted from? Because let me go back real quick, because these fees here, we're talking about deducting them from the cost of sale. So when it comes to a 1031 exchange, this causes so much confusion because people don't understand what is actually the value that they need to buy for. So if they sold something for $1 million, they feel like, okay, my actual gain in the property, maybe it's 500,000. So we have some clients that have that thinking that all they have to do is buy equal or greater to the gain. Then we have other clients that just feel like whatever the proceeds are at the close of escrow. So say they sell for $1 million, whatever those proceeds may be, say it's 700,000 because they paid a loan and paid for all those fees, and they feel that's the value they have to buy equal or greater to. So the reality, let me answer this question. The reality is they need to buy equal or greater basically to their sales price. So in this example, we have $1 million sales price, but they can deduct the fees that we talked about here on this previous page. So let's say they had $1 million sale, between the commission and all these different fees, let's say this is $75,000. So they can deduct $75,000 right off the top of their $1 million sale. And that's as low as they can go without a taxable event. It's as low as, so $925,000 is as low as they can go. But inside that 925, we have here, we have $300,000 of a loan that was paid off. Now the loan doesn't just go away because it's paid off on the sale. What IRS requires is to buy for $1 million. And let's make it easy. Let's say this $1 million is after they deducted those fees that we just talked about, the non-recurring closing costs. So that's already deducted out. So now we have $1 million. So the loan debt was paid off of $300,000. So that leaves them with $700,000 cash. So that's $700,000. If in the replacement property, the only way they're going to buy equal or greater to what they sold for after fees is they need to buy for $1 million. They need to get a new loan equal or greater to the loan that was paid off for the 300 in this example, and then use their $700,000 cash equity that came out of the sale as their down payment. So the 700 getting the new loan, that's how they buy equal or greater to the $1 million. So the loan debt does not go away. IRS, to have a totally deferred exchange with no taxable event, IRS requires that all cash be used and replace the loan debt either with a new loan. Maybe they get private financing. The seller will carry back a loan on the house they're buying. So private financing, private money, seller financing, excuse me, or private money, all that qualifies, whatever it takes to get a loan. Or if the taxpayer has their own cash and they don't want to have a loan, then all they need to do is bring their new cash to escrow. So they bring $300,000 to their purchase escrow. That new cash will replace the loan debt that would have needed to be, the loan that would have needed to be obtained. And now they can have this, own this property free and clear. The new cash replace that loan, and they're able to totally have a total deferred transaction. If they did not replace that loan debt and say they just used the equity and bought for $700,000, then that's what IRS refers to as a partial exchange. And they would have to pay taxes on the $300K of the loan debt that they did not replace. So it'd still be a qualified exchange, but they would be paying capital gains tax on that $300K. Okay, anybody have any questions on that? Go ahead and post it in the chat. So now, we talked about if they didn't buy equal or greater, they would have a taxable event. And what that, in the code, the tax code, this taxable event is referred to as boot. And so there's two different types of boot. The first type is cash boot. If there's any money left over in doing their exchange and they didn't spend all that money, then that would be cash boot, and that money would be taxable. We have mortgage boot. So if that loan debt was not replaced with the new loan, or perhaps they bought down and their loan debt was less than what they needed to have a totally deferred exchange, then they're going to be paying taxes on loan debt that's not replaced. Now, what's important to know is with the 1031 exchange, if the client did not do an exchange and they just sold a piece of property, investment property, and they say they just want to pay the tax, that's fine. But the state of California does have a withholding requirement. And they require that 3 1/3 of the sales price would be withheld at the close of that sale, and that money would go to the state of California, and it sits with them until that taxpayer files their tax return. And when they file their tax return, and if that withholding was more than what their taxable event would be, they get a refund. And if it was less, then that taxpayer pays the difference. What's important to know is if mortgage boot if the mortgage debt was not replaced, or they bought down and part of that debt was not replaced. Unfortunately, the state of California currently, which will be changing hopefully pretty soon, but currently, the state of California still requires a withholding, even though we're not talking about cash out of hand. Maybe they used all their cash and they just didn't replace all the loan debt. That difference of loan debt that they didn't replace, or whatever it may be, the whole amount, a portion of it, they still have a withholding of that 3 1/3 of that value of the loan debt. So it's just important to know. IRS does, as far as IRS is concerned, they don't have a withholding. This is only for the state of California. So I just wanted to bring that out. There's a couple more questions in the chat. Okay, so Wendy says, if owned in a trust, the heirs receive. Okay, so the question is, if not sold immediately, the capital gains will be. Oh, I can't tell what the question is. I'm sorry. I think we're okay. Okay. I'm sorry.
Yeah, Debbie, I was just responding to everyone. Your responses were just going to myself and Frank, so I put it in the chat so that everybody can see. So we should have asked the question, and so did Wendy.
Okay.
I just copied over your answers over.
Oh, I understand. Thank you. Thank you very much. Okay, so I wanted to talk a little bit about, before we're going to take a break in a few minutes. In regards to boot, some people, we have a lot of clients that are baby boomers and they don't want loan debt. So maybe they're selling something, the loan debt is sort of low, maybe it's 125,000, and the cash that came out of the sale, maybe it's like 900,000. They just want to spend that money and not buy where they have to have a loan. That's fine. That's called a partial exchange again. We're referring to this as a partial, and they bought down, so they're just going to pay taxes on the difference. So if that's what what we recommend is for that taxpayer to talk to their CPA so they understand up front what that taxable event may mean. So it may work out for them, or they may, after they hear that number, may decide that it's worth getting a loan. But it's very important for them to talk to a CPA so that they can understand what that taxable event would be if they bought down. Another thing to remember when it comes to exchanges is we're talking about they need to buy equal or greater to their sales price minus those fees. So some clients have this great idea that if they bought equal or greater, so let's say they buy 100, okay, so let's say that they buy totally exactly equal to what they sold for. So let's go with that $1 million example. They sold for $1 million after fees, and they decide that they get a loan, whatnot. Then after they're done, they want to maybe, whatever. So it's real important that they don't refinance too soon. They need to wait at least 3 to 6 months, let it season, and then they can check with their CPA, make sure there's no questions, no issues, and then they can refinance at that point. So some people put their money in it, and they feel like this is a way to perhaps move forward, and then later they want their money back. So that may be an option for them, but they need to check with their CPA. Other people will buy equal or greater to what they sell for, and they decide that they would rather, when they're all done, they want to pay off the loan debt. Maybe they got a loan and they're worried, well, can I just pay off that loan debt? They can pay off loan debt anytime. It doesn't matter. IRS is fine. New cash always replaces no loan debt, so they can pay. They can put in their own loan money, pay off their loan debt, whatnot. Other people will get a loan higher and have money left over. and they bought equal or greater, but their loan debt is higher than what it should have been. And they think that should work. But if there's, even though they bought equal or greater and they have a loan that's higher, if they walk away with money, that money will be taxable. So that's, I just wanted to give you a few examples of what could cause boot. Okay, well, why don't we just take a break for the next little bit, and then we'll come back and Frank will start with slide 12. But I'm thinking we're almost, what, 10 minutes of? We'll give ourselves a few minute break. We'll resume at 2 o'clock. Okay. Okay, we're back.
All right.
Okay, so up to this point, we've talked about the economic factors. We talked about what you need to do by equal or greater to what we sold. We've talked about title issues. Whoever's on title on the sale needs to be the same party to be on title on the purchase. So the same taxpayer on both sides. So now Frank is going to take and talk about the time frames. So have.
Yes, so timing is really, really, really important. Okay, out of those parameters, basically an exchange will be disqualified. So you really want to know and be very familiar with those parameters. So when does the timeline start? It starts from the day of the close of escrow of the sale property. So let's say you close escrow on an exchange property today. You will have 45 days from today to identify in writing basically your replacement property. And there are different rules that will go over that, but you have basically to put in writing what you're going to be identifying specifically. It cannot be just a bunch of addresses. It has to be exactly, and I'm insisting on that exactly, the property address that you are going to be replacing. Okay. And then from that 45 days, you will have another 135 days to close escrow on the property or properties that you have identified, for a total of 180 days. Now, what we would suggest is that 45-day identification period, exchange registers will provide you a form that your client would complete and write down what they are intending to buy. But just to basically put that form aside, right, and then concentrate more on doing the research, putting an offer down, doing the due diligence, getting that property to the point where they know they will close escrow on that property. And when they are sure, then take that form, that piece of paper, and actually identify the property that they are intending to purchase. Okay. Now, a couple of things on the 45-day window. Some people are going to say, "Wow, 45 days, that's going to come really quick. It's really hard to do, especially then a market like we are in, where you have low inventory, and it's hard to get something accepted when you're competing with so many other people." So what we would suggest is that as you get an offer on that your sale property, to try to negotiate a longer escrow period, by maybe 45, 60 days with an extension. And this way, you would use that longer escrow period to really try to identify what you want to buy. Like I said earlier, to write an offer, getting all your due diligence done, and then once you know that you're going to be closing on that property, that you're going to be moving forward, then proceed and close the escrow on what you are selling. This way, you'll be using your free time really, and you will not be tapping into that 45-day identification period, which can go very quick. So that's one of the strategies that we would recommend for you to work with in getting an offer accepted on the property you are selling. So that's something to seriously consider. And then talking about the type of the rules as far as identifying properties. So most people would use what we call the 3-property rule, which consists of identifying 3 properties regardless of value, and taxpayer could purchase either 1, 2, or 3 properties. And again, in order to achieve full tax deferral, then you want to get a property that is equal or greater value, or if it's 2, something equal or greater. If someone is wants to identify or purchase more than 3 properties, let's say they want to purchase 4 properties, then it's where the 200% rule would come into play, where they would be able to identify, in our example, 4 properties, but the total value of those 4 properties would have to be equal to 200% what they are selling. So if they are selling for $1 million, using the 200% property rule, they would have to purchase or identify for $2 million, right? And as many property as they like within that $2 million. So the two times what the value of what they are selling. Now there's a little caveat into that. If they are identifying more than 200%, let's say they identify for 225%, for example, then in that case, they will be obligated to purchase 95% of that total value they have identified. So doing the homework and really figuring out, what those replacements are going to be and the value and so forth is going to be really critical. Because again, here, this has to be very specific in identifying those properties with that rule. Another thing that we may suggest when you identify is to perhaps identify something, and we'll talk a little bit more about that later, but what we call a Delaware Statutory Trust, or a DST, which is basically purchasing a fractional interest of a larger investment type property, like institutional grade, for example. It could be like a 300-unit apartment complex. And then to identify one of those property as a backup plan, because we've seen it, so many times. People identify, let's say, a couple, properties, and things go wrong on those, and things are not going to work for whatever reason, with the inspection and so forth. And then past that 45-day window, then there's no more. It's not possible to make that change. So having that additional DST type property would be a good backup to fall into if traditional property are not, will not work. Now, past that 45-day window, let's say someone wants to make a change on day 46, that would not be possible. That would actually be too late. And so the change would not be possible on that identification 45-day period. Any change before the 45 days, that's okay. But past the 45 days, again, I repeat, that's not going to be possible. I hope this makes sense. Please let us know if you have any questions, or we can answer them, later as we proceed. Debbie?
Okay, thank you, Frank, for that. Now, as he referenced, these timeframes are what will make or break the exchange. So that's real important. Okay, so now we're going to have a few slides that go into different types of exchanges. And this one is something that it can be difficult to try to make happen, which would be a simultaneous exchange. So basically, they've been out looking, they've sold their property, they've been out looking for a replacement property, taken advantage of perhaps that longer escrow period if you're able to negotiate that for your client, and finding a property so that in the end, they all close within a day of each other. So even though that's not simultaneous where they're exactly one closes and within the next few minutes, the next one closes, but if they close within a day or so of each other, that's wonderful. But there's a few things that people need to understand. One, regardless of the fact that with the 1031 exchange, one of the rules in the exchange is that the taxpayer, the seller, can't have control of those proceeds, the money that comes out of escrow. So that's why we work with a qualified intermediary, because per the tax code, a company like what we are, we facilitate the exchange, and we make sure that everything's done properly according to the code. Well, with this situation, with the simultaneous exchange, some taxpayers say, well, why do I even need to work with a qualified intermediary? Because I'm not going to, escrow is going to close, the sale proceeds are going to be wired directly to the purchase escrow. I'm not going to control the funds. So then I don't need to do this whole work with a qualified intermediary step. But the reality is, even though the taxpayer is not touching the proceeds, they are actually have what IRS refers to as constructive receipt of those funds, where they have control of where those funds go. So the simple act of directing the proceeds to go from the sale escrow to the purchase escrow would disqualify any exchange, thus needing that third party. So for us, we may not take receipt of those funds ourselves, but we would, in our agreement as a third party, again, totally in accordance with the tax code, we would set it up where the sale escrow, we give the instructions to the sale escrow to wire those proceeds directly to the purchase escrow. So it circumvents coming to us, but we're the ones that give the instruction, not the taxpayer. And by following the procedure in that way, it will be a totally compliant exchange. What's important to know is that holding the money, having control of the proceeds, that's just one portion of an exchange that is qualified. So some clients have called me up and they said, I didn't get the exchange set up. Escrow closed, but I didn't touch the money. The money's still with the escrow company. And I'll ask, well, when did it close? A month ago, but I haven't touched the money. Well, the fact that they haven't touched the money is just one part of the pie, a piece of the pie, because the reality is it's too late. They needed to have set that up before the closing, and then those proceeds need to come to the qualified intermediary, but the paperwork and all the structure of the exchange wasn't done. So it's too late to go back and fix it. So I just wanted to bring that up, that it's just because the client doesn't touch the money, it's just, that's one piece of the pie. There's a lot of other criteria that are involved. Okay, so we have simultaneous. The next slide talks about a different type of an exchange. And this is called the reverse exchange. And the reverse exchange is really, truly the most complicated exchange in the tax code. And we're not going to go into all the nitty-gritties of the reverse exchange, but I want to at least give you the structure so you understand how it works. And there's some clients that this may be the perfect tool for them. So we'll talk about this. So a reverse exchange basically allows the taxpayer to buy the replacement property first and then sell. So if they have the resources, if your client has the resources and they're selling something that they know will go pretty quickly, but they're looking for maybe a very difficult property, maybe those perfect units right on the beach or whatever it may be. So they are afraid to sell and have the 45-day clock because they may not find that property that they're looking for. So this creates a perfect scenario for a reverse. So the reverse allows the taxpayer, like I said, to buy first. So they find that perfect property and they use their own funds to buy. And according to the code, if they bought something, now they own it, and they have something they're going to sell and they own it, if they own these things at the same time, they just disqualified themselves from being able to utilize the 1031 code, because you can't exchange on property you own. So because of that, IRS came up with the revenue procedure, and basically this is it. We create a shell corporation. for the transaction. We'd create basically a C Corp. And then before escrow closes on what they're buying, we decide one of these properties, what they're selling or what they're buying, one of them gets deeded to this corporation. So we figure out which one needs to be. If they're buying with financing, then we're not going to mess with that. Then they can buy in their however they're going to hold title, the same as they hold title on what they're selling. So we're going to come over here to the property they're selling, and that's a property that would get deeded to this corporation. And that needs to be deeded. We deeded a few days before closing of the purchase property, because the day after deeding that property to this corporation that we created starts the clock for the whole transaction. So the day after deeding, the client has 180 days to sell what they have to sell and close escrow. So we're going to go with, that's what they're talking about. We have option A and option B according on the slide. So option A is we're going to park the property they're selling, which is the relinquished property, in the corporation. If they're buying with cash and there's no loan involved, then we're going to take the property they're buying and deed that to the corporation that's created, and that would be option B. So now what happens is at the closing, when they get their 180 days, the day after closing or the deeding, they have their 180 days. When that relinquished property is sold, they will then, those proceeds will then go either to the exchange account or to the corporation, just depending on which one that we're holding in the corporation. And then those funds will then be used to reimburse and pay back the taxpayer for the money out of pocket. So for example, if they sold and they had $1 million cash, then, and the taxpayer, just to get in the property, got a loan and used the least amount of money he could to get into the property, just so that he could buy it. Now that with the sale proceeds, we'll use that money to reimburse the taxpayer back money out of pocket and pay off that loan. And so that now that property would be owned free and clear, exactly what he would have done if he would have sold first. Some people have higher loan debt than what they want. We'll pay down the loan debt and still reimburse the client with money out of pocket. So whatever needs to be done with those proceeds, that is where the tax deferral comes in. They get reimbursed and pay down or pay off loan debt that wasn't intended to be there. So it's complex as the reverse exchange technically is. For the taxpayer, it's probably the easiest exchange because it relieves the taxpayer of the stress of trying to find something within the 45 days and identify something and make sure that it's okay. And so by finding the property first, it takes that stress off of them. But there still is an identification period. So what happens is if they're identifying, or excuse me, they're going to identify what they're selling because they've already purchased. So if they're going to sell, some people know exactly what they're going to sell and they only have one property, then that if we park that property in the corporation, then that's an automatic immediate identification. If we're going to park the purchase property in the corporation, then we're going to have an actual process where the client's got 45 days to identify what they're selling. Some people don't know. They may feel that they may have 3 properties and they would, whatever goes first is what they're going to sell. So maybe we will be identifying all 3 as on the ID sheet. And then whatever does sell would be what would be used for their to reimburse them for the replacement property. So the reverse exchange can be the right tool for the right person. It's not for everybody. It's a much more expensive exchange. But for the person that needs to find that perfect piece of property, it could be a good tool. For someone that perhaps worked hard, they, forget the reverse. They sold their relinquished property They had a longer escrow. They found the replacement property. They did their inspections. Everything seemed fine. And then somewhere down the line, something fell apart and they lost that replacement property. So this, when it comes to a reverse exchange, since that property's been lost and they're still have, they haven't closed yet. Oh, excuse me, let me back that up. Excuse me. I'm confusing this. What happens is the relinquished property, the property they're selling, falls out of escrow and they're in contract on what they're buying. So now they have a choice. Can they get out of what they're buying, or should they just move forward with what they're buying, do a reverse, and then try to sell the property? So a lot of people stumble into the reverse because of a scenario like that. So thank you. Excuse me, I got mixed up there for a moment. Okay, so that's the reverse. The reverse allows the taxpayer to buy first, sell later, but it's not for everybody. Okay. The next is a very interesting exchange. This is a build to suit. And this also is an extremely complicated exchange, but it allows the taxpayer, if they buy less than what they need to, it could be a perfect tool to allow them to do improvements on the property and use exchange funds to pay for those improvements. So let me explain how this works. So let's go back to that $1 million sale, but let's say it's all cash, no loans involved. So that property was owned free and clear. So the taxpayer found something for about $700,000 that he wants to buy, but it needs extensive work. So what they would do is, if they want to utilize the build to suit, they'd use the first $700,000 to acquire the replacement property. Then the ID form, then they're going to close on the sale. When they close on the sale, property starts this time clock. So they get a total of 180 days, like Frank brought out earlier, with the first 45 days to identify what they're going to buy. So they would identify the replacement, the property itself, but then they're not just identifying the real estate, but they're going to identify the improvements that need to be made on the property. So they're identifying the real estate itself and the improvements. So what happens is once the clock starts ticking, the sale is closed, the proceeds are there, we close the purchase property. Now we have the rest of the 180 days to make those improvements. So the taxpayer would need to have the contractor in place, work with get all the ducks in a row, because there's a time frame here. They have to actually be done with whatever improvements by midnight of that 180th day. Now, these improvements aren't needed. If they had a whole bunch of improvements to do, they don't have to finish everything. They just need to spend their money on legitimate improvements that were made. So for example, they have $300,000 left because they bought for $7 million. They redid a kitchen and redid bathrooms. They maybe it's a duplex. They did this on both sides. They're spending all their money as much as they can. The proceeds are held at the qualified intermediary. So if we're the QI, we would be holding that in their exchange account. So we would actually be paying the vendors. We would be paying the contractor for the work being done. But the code does not allow for like payment of things that haven't been done. For example, just buying material and having it dropped off on the property, roofing material, whatever, that doesn't qualify. It has to be whatever work is being done on the property. The work needs to be done. The work needs to be done, and the improvements need to be installed in the property. So if you're putting cabinets in it, you can't just buy the cabinets and leave them in the garage. The cabinets need to be installed, thus making it part of the real estate. So as the taxpayer is going through this process, if day say 175 comes and they have maybe 25,000 left in their account, then what would happen is we would go ahead by the 180th day, deed the property back to the client if we were holding the replacement property in the corporation. And then whatever monies are left in the exchange account, their exchange is beautiful. They're just going to pay taxes on whatever's left over. So it sort of helps the taxpayers so they can understand. Sometimes they can't get everything done because of schedules and contractors, whatnot. But a build to suit takes a lot of pre-planning, takes a lot of coordination so that everything can go as smoothly as possible. And as you know, we all know that it's still not that smooth. But the end of the day, if not all the money is spent, doesn't hurt the exchange. The taxpayer just pays taxes on the difference. So if they go into it knowing that at least they saved so much money in a taxable event, and they were able to shelter it on those improvements, so if there's money left over, then it still may be a win-win for the taxpayer. Okay, so that's the build to suit. We just briefly touched on it. There's so much that's involved, but I think there's one more thing to bring out. Some of the fees that are allowable, even though it may not be installing things on the property, would be the planning and consulting stages. All the plans, they can use exchange funds to pay for that. If you had a CPA that had to do a lot of number crunching and there's a little bill there, that money could be paid to pay for that. You can pay the contractors, the permits, the architects. Sometimes between the architect, then the permits and the planning stages, between paying all that out, sometimes that uses all the exchange funds. Then that would be the end of the build to suit. And then we would just deed the property back to the client if we were holding the replacement property. And if otherwise we deed, then the exchange would be done because all the funds have been spent. So it may not be actually even used on the improving of the property. It may just be used on the architect, permits, consulting, things like that. Okay, let's go on to the next slide. Can we acquire property out of state? Absolutely. A 1031 exchange is a federal code, and so you can do exchanges all over the US. We work nationally, so we work on properties all over the US, so it's not a problem with us. But California does have a certain procedure in place. It's called the clawback. And this is where the state of California requires, if a taxpayer leaves the state, so say they sold California property and they went to Florida. So they left the state, then every year that taxpayer needs to file a 3840. This is the form number with the state of California. And all that is it's called an informational return. So if they file this 3840, they do it every year. The state of California wants to know the status of that property. They want to know that the taxpayer still owns it. If they ever sell it later down the line, even 10 years from now, they sell it, then the state of California, and this is why they do this reporting, this filing every year with the 3840, the state of California is going to require at that point the taxes that would have been paid on that sale in California 10 years earlier. They're going to require that money. So California is tracking their funds, and if a taxpayer fails to file the 3840 and they don't file that informational return, then the state of California actually defaults to making them pay the taxes. So that's how important filing that form is. So, and you know, there's a lot of other states that do have this type of provision where the state does follow their money. And it would have been, if they would have sold and didn't do an exchange, that was a taxable event that was owed to the state of California. So even though they did exchange and they moved out of state, eventually if it is sold, it's, California's just asking for their tax that was due. Okay. Now we're getting to this next slide. It says, what if a client has a partner? So a partnership are fine with exchanges if it's literally structured where a partnership owns the property and the partnership has its own taxpayer ID number. then again, it's like that entity, the LLC. The partnership is the owner of the property, and the partnership would be doing the exchange, which makes it difficult because each partner may have their own goals and ideas of what they want to do. If this partnership is what we talked about earlier, is a result of a TIC, a tenants in common, where each partner, they have a partnership between them, but each partner is on the deed. Then, like we discussed earlier, they have the right to do what they want to do. One can do an exchange, and the other one can just pay the tax. They individually can do what they want to do, but it is 100% different when a partnership owns a property and it's not separated out as tenants in common. So again, that's just something that takes some planning, takes time to restructure and separate. They would pretty much, the partnership would have to buy. Then after about 2 tax returns, they can dissolve the partnership and deed out and deed to each as tenants in common, and they can go their way. But again, it's not a quick fix. Okay. Frank, do we have any questions? Okay, so let's discuss.
Without questions.
There's none?
No.
Okay, cool. Okay, so we're also going to talk about the biggest question a lot of exchangers have is when can they have access to their exchange funds? So let me explain. When it comes to someone doing a 1031 exchange, when it comes to setting up the exchange with their qualified intermediary, what happens is they provide documents. So the nuts and bolts of the exchange is the qualified intermediary would become assigned into the transaction. So now they're going to join the seller who initiates the exchange as a seller. So the amendments and the settlement statement through escrow, the estimated settlement statement. Now, once the exchange has been opened and they have the exchange, they've entered into this exchange, the seller now, the identity sort of changes. So it'll be like Exchange Resources, FOB for the benefit of, and then say Debbie Bannister. So because of that, what happens is that when the exchange is set up, we set up an account, a segregated account for the client. And when the sale escrow closes, those proceeds go to the sale to that account. And again, as we talked earlier on in our discussion, the client can't have control of those funds. So the big question is, if something happens and maybe everything falls apart, when can I have my money back? And, you know, is there a time that I can have access to those exchange funds during the exchange? Maybe I just want some money and decide that I don't want to spend all that money. I would rather do a partial exchange, but when can I have some of that money? So the most important thing to realize is that first, if an investor has not identified any replacement property, once the 45 days have started, if they have not identified and now we're day 40 and they call us and they say, we're going to cancel. We want to get, we can't do this. We can't find the replacement property. So we cannot at that moment return those proceeds. We have to wait for the 45th day to come and pass. Now the 45th day has passed. The most important rule has been broken. The identification hasn't been made. So now we can end the exchange. So the exchanger has to wait the first 45 days. If they can't identify, once the 45th day has passed, if day 46 is a business day, then we will refund those proceeds to the taxpayer and then their exchange will be done. Of course, we have the withholding that we have to do for the state of California, but the exchange will be done. If the client identifies a property and they're working on, on the property's being, it's been negotiated, it's been contracted, but then something hit, the 45th day passes. And say now we're day 60. So we're past the 45th day. and something happens and the exchange falls apart. Now, we are under obligation with IRS that we cannot release those proceeds until that 180th day passes. So the 180 day has to pass, and then the 180th day, and then if the 181st day is a business day, then we'll set up the wire and get it all together so that we can wire those proceeds back to the client, take the 3 1/3 withholding out for the state of California, and the remainder of the funds go back to the client. But it's very staunch. So we try to warn and help our clients understand these timeframes, that we cannot return money before the 145th day. I mean, excuse me, that would be rough. We can't return the money before the 45th day has passed. And then once we've been past the 45th day, if something fell apart, we'd have to wait for the 180th day to pass. There's one exception. If the client only identified one property, only identified one property, and that's the property that fell apart, then, oh no, excuse me. Actually, let me back that up. 180th day, that's it. I'm trying to create something here. Doesn't work. Okay, so let's go on to the next slide. What we like to do with with you guys and help you understand with our clients, we do a lot of webinars, but we also have some information that we can provide for you clients, for you. We have PDF guides and exchange information that we like to help, so that at least the client and you have something in writing. You always have us to work with you. But we also provide a capital gains worksheet so that the client can do their own math, so they can figure out how much gain they may have in the property. And if an exchange may be, the exchange may or may not be of value. So it's important. So a lot of times when a client calls me to begin with, I really like to sort of figure out what that taxable event would be, so that maybe an exchange would not be of value for the client. And if it seems that way, then I would really highly recommend, when I talk to the client, for them to talk to their CPA, because if they don't need to do an exchange, then it sure makes their life a lot easier. So it's real important that they do their homework too up front, so that they can figure out if the exchange is of value to them. Okay.
Then a couple quick things. If Elsie, if you're able somehow to provide us the participants' email, or maybe we can email that to you, we'll be happy to send you some letters to for the participant here to send to their prospects, and other little things like conversation starters and things like that. We'd like to share with them so they can use for their own marketing. And like Debbie said, we are always happy to join you with, if you have a conversation with your client and you need some 1031 support, we are always happy to jump in and to assist.
Okay, does anybody have any other questions? We're sort of wrapping it up a little early today. I think what's important to know, just as a conclusion to everything, is that sometimes people are afraid of a 1031 exchange because they feel that it's too complicated. It's so many things can go wrong. Sometimes a seller doesn't want to sell to somebody doing a 1031 exchange. I get the agent calling me up saying, okay, how is this going to affect my client if they accept an offer from someone that's doing an exchange? And I just want to say that a 1031 exchange, if with the right team, doesn't have to be so difficult. Not to say there aren't solid rules, like Frank brought out, with the time frames, the identification. We have rules that the client has to abide by to have a successful exchange. but we really work hard to try to take a lot of the stress out of it for the client. And when it comes to a client selling, if you're ever representing a client that's selling a property and the buyer is doing an exchange, that buyer is most likely very strong and is probably one of the best buyers they could have out there, because they're not in it to play a game. They're in it to close escrow, get done, so that they can satisfy their exchange requirements too. And a lot of them have very high cash positions. Loan to cash ratios are very high. Some of them, a lot of the clients are even all cash buyers. But I have a lot of agents representing sellers that are doing that have buyers coming in with offers, and they're afraid of their seller accepting an offer with someone doing an exchange, and there's no responsibility. The seller has no responsibility when it comes to an exchange with their buyer wanting to do that. So I just wanted to bring out that exchanges don't have to be that difficult, but it is important to have the time for planning. Okay. Let's see here. I see.
I think we have a question. Ben is trying to ask a question. Ben, just put it in the chat, and then we'll answer your question there.
Yeah, I don't see it. Oh, okay. Thank you, Ben. So there's no question.
Do we want to answer, Debbie, that earlier question? Let me
Which
see.
one is that?
I think we had one with if a relinquished property needs to be remodeled before listing, what is the best way to utilize high
Oh, I
equity?
see. Yeah, I was looking at that. I don't know if I totally understand the question, because it said the construction exchange cost is too high. The seller's considering to cash out 8 months later.
But I think, yeah, like Debbie mentioned earlier, talking about the build to suit is, if you, for instance, want to use that equity with, through a line of credit and all of that, I mean, you can do that, but this will be considered a loan against the property. And then whatever you are, improving, then you would have to work with your CPA on that, as it, if it qualifies, maybe added to the basis of the property.
Yeah. Sometimes with the construction fees, it offsets the gain where they may not have to do an exchange, but you want to be careful, because I don't know if I misinterpret this question too. If someone does an exchange in anything, whatever they're selling or whatever they're buying, you want to make sure that it is held for investment purposes. It's not just bought for the sake of flipping. So short-term owning something and turning around and selling it wouldn't necessarily qualify for a 1031 exchange. So I don't know. I might have misinterpreted that question too, because it said that considering to cash out 8 months later.
Yeah. And then it
Yeah.
looks like
With private financing, probably not selling.
yeah, it looks like the question was a quick cashing out 8 months later for your replacement. So yeah, we'd like to see at least 1 to 2 tax returns. I know there's no specific language as far as how long to hold, but 1 year or one tax return is recommended. And then us as a company, we recommend 2 years.
Exactly. And there is a question here about relinquishing 3 properties for 5 or 6. And in this whole discussion, we just talked about 1-to-1, but absolutely, you can sell 3, and the cumulative value of all 3 of those properties would be what you would have to buy equal or greater. And then you can buy several, 5, 6 as a bundle in the replacement properties. And as long as the cumulative value, what you're buying, is equal or greater to the cumulative value, what you sold, you can totally defer your taxes. But you absolutely can sell multiple and buy multiple, or vice versa. sell multiple to buy one, or sell one and buy multiple. So however it works out, you can do that.
The only tricky part is going to be the timing of doing all of that.
Exactly. Because the first escrow that closes, if you're selling multiple property, like in this question, 3 relinquished properties, the first one that closes will start the clock for the whole transaction. So the first one may need to be negotiated to have a longer escrow, as long as you can get away with. And then you've got the other 2 properties to be sold. Maybe it can be shorter so that everything can be pretty concise. But just remember, when you're selling multiple properties, the first one that closes starts the clock for everything. Okay. Oh, here's Ben. When my seller wants to do an exchange, it can be for personal property or investment, correct? It needs to be not for personal property, just investment. Personal property does not qualify any longer since 2018. It was removed from the code. So it would be for the investment portion, the investment property. I hope that answers that. Okay, unless there's any other questions, we'll go ahead and we're going to end the class. If you have any questions, you feel free to call. Frank and I both answer the 714-269-1285. You can email also that you see below. We'd be happy to answer your questions, or if you had further questions that we didn't have time to discuss during the class, we'll be happy to answer those questions for you. Okay. Anything else for you, Frank?
I think that's it. Yeah, we are here. We are here for you. So just give us a call, and we'll be there to help.
Perfect.
Thank you.
Okay. Thank you, everybody. Oh, wait a minute. There's a couple more questions. Oh, you're welcome. You're welcome. It was our pleasure.
And
Thank you, everybody.
And see if you can just somehow provide us or facilitate so we can send the group some marketing materials they can use, in their prospecting. Thank you.
Perfect. Okay. I think we're.
And I think I'm sorry, I cannot resist to ask. There's one quick one, I think, from Ben again. Yes, we'll be happy to come and do events at your office. Ben, just let us know how you want to set that up. But we do come to offices and do individual classes for offices. Thank you.
Okay. Well, everybody, thank you so much. We look forward to talking to you in the future and helping you. But for today, have a great rest of your day.